Everyone, my name is Simon Mishevich,
And my name is Louise Mishevich.
and tonight is the live show where you can ask your business or your property investment tax questions. And because it is live, what time is it, Louise?
Well, where we are, it's 9 p.m.
9 p.m.
Burning
Can
the
anyone
midnight
guess
oil.
where we might be?
Considering it's 8 p.m. in the UK, there's not an awful lot of options, really.
Yeah, de donde es usted?
Hola.
Right. Where are you from is the question I asked, and she said hello. Brilliant. So there you are. So good evening, everyone. This is live. I'm just going to check that we are coming across correctly. So I'm just going to go to my videos, and I can see we are live. So
Hooray.
Good evening, everyone.
Hello.
This is going to be a show where you can pose your questions to us. We do have a special guest with us tonight. And who is that special guest, Louise?
Well, that would be someone also called Simon. So the lovely Simon Hodgson will be joining us shortly, and we'll be talking all things to do with mortgages and finance.
Buy-to-let mortgages. Interesting. So we'll save that till later, because what we try and do is get our guests warmed up for around about 8:30, and then we'll go on for an hour with them and then get your questions answered. But before then, what we'll be doing is answering your tax questions, or business investment tax questions.
Absolutely.
So without further ado, what I'm going to do is jump into it, if that's all right with Louise.
Feel free to.
Perfecto.
I don't think that's Spanish.
No, it's not. Well, perfect is Spanish. Okay. So thank you. Muy bien. So what I would like you to do is, if you are watching this live, please do type your questions into the chat box.
And say hello.
And please don't test us out on Spanish, because we will just use Google Translate. So it can't be says.
We're learning.
We are learning. So feel free to post your questions, which I can see someone's already posted a question.
Hooray.
So let's answer that question, Louise. So Sean,
hello, good evening, Sean.
Has asked a question: how do I start a SIP or a Sass?
Ooh.
Before we go into the answer to that, it's worth just saying what a SIP or Sass pension is, really. So a SIP or Sass pension is a pension fund that you could put money into and get tax relief on the money that you contribute into your pension fund. That pension fund can grow tax-free, and the income generated from that pension can also be tax-free as well. The nice thing about pensions is it is free from inheritance tax as well.
Hooray.
So from a SIP and a Sass is quite different, I would say. So the Sass for me is a stakeholder pension, and a SIP one is pretty much a self-invested personal pension, which you could control as an individual. But Sass typically it'd be an employer-based one, and it can take between 6 and 9 months to set up a Sass pension, which not many people talk about.
No.
Compared to a SIP, which can be done over the weekend, literally a few hours of your time, and it's done. And much cheaper as well. So SIPs is Graham is saying hola amigos, hello friends. There you go. Hola. Buenos dias, buenas noches.
Buenas noches.
So yes, so indeed. So any comments on that about pensions?
I think a lot of people come to us with a misunderstanding of what a SIP or Sass is, and they sometimes believe that it's perhaps more than it is, that it's something very different to a pension you could take out in any other way. To a degree, all pensions are the same in the sense from a tax angle. There are ways in which you can invest perhaps taxed money to grow tax-free, and as Simon says, to be inheritance tax-free as well. The beautiful thing about SIPs and Sasses are that they are much more self-directional. In other words, you are the fund manager. You direct where those funds go within reason. There are certain conditions you have to follow and hoops you have to jump through and standards you have to meet. But you make the decisions as to whether you choose to leave it in a bank account, invest it in gold, invest it in perhaps even commercial properties in some cases. And that makes it much more appealing to those that really want to take control of their lives and their future livelihoods as well.
Yeah. And that's pretty much all we can really talk about on that. I would say that pensions are regulated, so you have to be careful of that. So pensions, SIPs are regulated by the FCA, so Financial Conduct Authority, where Sass are typically are PRA, so Pension Regulatory Authority. But both are regulated. But do your due diligence, check out some of the service providers out there, and good luck with that one. Steve's asked a question, so there's a couple of questions. In fact, I should be using my new technology, but I'm not using it, which is a bit of a shame. Did you get my email question in, Steve Stanford? Steve, if you sent that in just recently, probably not. So do ask it here if you want to. But let's have a look at Steve's question anyway. So Steve said, how can I use holding companies to reduce tax? I have a property in Spain.
Hola.
So I'd like to bring it under it as well as my main business in the UK. So that's an interesting thing, because we're obviously in Spain. We're doing an awful lot of work for Spain as well. We're working with a strategic partner for that, but pretty much I can give you advice around about tax in Spain. It's not too dissimilar to the UK tax. Now, if you have a property in Spain, you typically could own that in your own personal name. You could own that in your UK limited company. I don't see any issues with that, but I do know that banks are very particular in regards to ownership of Spanish property and prefer it to be in your personal name. You can have it in a limited company, but it will cost you more in the amount of deposit, that you put into that property is significantly more. Any comments from you on that one? About Spanish property. We'll move on to holding companies.
Yeah, I guess that it bears some resemblance perhaps to the UK a few years ago, in that you would pay significantly higher interest rates if you were to procure a property in a limited company, so a Spanish limited company, compared to your personal name. There are some rather nasty kickbacks at the moment, in the sense of us now being, so UK now being outside of the European Union. There are some very nasty kickbacks with regards to how your tax is calculated on such properties. So you just need to be careful about how you choose to compile your total portfolios across the world. You have to be careful of that.
Yeah, I mean, that's an interesting point, because now we're not in, now Brexit's happened, we're not part of the EU. Spanish tax authorities now will tax you as an individual, or indeed in the company in the UK, 24% on a gross rent. So not even allowing you deductions. So it means that you have to pay gross on a quarterly basis to the Spanish authorities. And I have done a video on that. I think it's being released in a couple of weeks' time. So do be on the watch out for Spanish properties. Move on to holding companies. I mean, holding companies in itself, I think sometimes they're overly used. I mean, holding companies, let's think about what they are. A holding company is a company that is owned by you 100%, and then the holding company will own subsidiaries, which is nothing more than a technical term for other limited companies, or SPVs, if you like. Holding companies can be very useful because it does allow those individual companies to move the money up to the holding company, and then you choose when you take the money out of that holding company so that you're not paying excessive tax.
And in the majority of cases, moving the cash from the subsidiary up to the parent company, if I can call it that, if you release it as a dividend, then the holding company is not taxed on it. So if you were the shareholder to that subsidiary, rather than having a holding company between, the moment that cash touches your hand, it's taxed, isn't it, under dividend tax rules? The beauty of a holding company is that when that dividend moves up to the parent, whilst it remains in the parent, it's not taxed further. Now, of course, it's been taxed in the subsidiary as a profit, but there's no subsequent secondary tax on it. Now, of course, you may be thinking about how to take that money out, and you may choose to take it out yourself as dividends, perhaps, and that's the point at which the dividend tax will kick in again, sadly. But if you're looking to maneuver money around your subsidiaries and holding company, then it can be a very tax-efficient way to extract money from perhaps a subsidiary that you are joint venture partnering with a third party, and then let it sit in that holding company until you've got a better use for it.
There is a slight nervousness that myself and the tax advisors have been talking about this in 2023, when the new tax regime for corporation tax goes up to 25% when you get to 250,000, I believe. And my nervousness around that is that you have this almost a kind of I'm not sure the terminology, I should know, but where you go from 19% to 25%, you're almost transitioning to that.
Yes.
And that starts, so up to £50,000, you are taxed at 19%. And then from that to 250, you have this kind of transitioning from 19 to 25, tapering, yeah, that's the word. And then from that 250 beyond, you pay 25% tax. My nervousness around this is the fact that that tapering is the kind of the way that the allowances are. It's split between all of your companies. So if you're not careful, you could have a company that's not making you any money that is taking part of your allowance, which means that that 250 is coming down by each company. So if you have 5 companies, actually what they're saying is once you get to £50,000 and above in any of those companies, then that would be automatically be taxed at the 25% tax rate. So
it's almost a cumulative valuation rather than an individual.
And it's something that we're picking up we're having regular conversations on a daily basis between tax advisors to say, well, actually, it's holding companies all that much. Great, because people do have dormant companies, and that's another problem. People do have dormant companies, which will be part of this 250 split. So you could be in danger whereby each of your companies is being taxed more simply because you've got all these dormant companies lying around. So do be a bit careful with that as it is. So moving on. Now, Sean has asked a question about, I would like to add a property. Sorry, to go on to that one. It says, I would like to add a property to a Sass. Again, you can add your commercial properties to your Sass. So this is quite regulated, so I don't want to make too much of a comment on that. I'm not regulated. I'm not a financial advisor. So do reach out to your Sass provider to get that property inside. But
be very careful what commercial means, because what you think is commercial may not be the definition of what the Sass thinks is commercial. So just be careful.
Yeah. I'm just saying, I think we can talk about this. What I'm trying to do is save the questions for Simon Hodgson wherever possible when it's about mortgages.
Put Simon on the hot hook.
We'll get him on the hot hook, as it says, yeah. So this is from John. It says, I've refinanced my personal buy-to-let portfolio to cap raise funds for a limited company development. How do you account for the additional interest costs in the personal name, but should be paid by the limited company? And we obviously spoke about this offline. Why don't you share your thoughts? Because I thought they were very good in terms of John's position.
So in some instances, there is the ability to claim that additional interest still against the personal property portfolio. But of course, Section 24 is now at play. And courtesy of Section 24, you can start to see if you like, minimisation of tax relief that you get on your mortgage interest. It's not uncommon for individuals to borrow money to fund a limited company, maybe getting it started for cash flow purposes or for opportunities just as you're describing. In those instances, I think it would be worth you going and having a good look at HS 340, so Help Sheet 340. So if you Google HMRC HS 340, there's a fabulous article there, really, and it explains how if you're lending money to a company in which you have at least 5% voting share stock, then you can claim a tax relief based upon the mortgage interest, but the loan interest that you're paying that is commensurate with the amount you've lent into the company. Consequently, that means it extends almost your personal allowance. If you're familiar with personal allowance and your personal tax returns, that's the amount of money you can earn tax-free every year. This HS 340 says is that if you are paying personally any interest on a loan you've lent to your company, you can basically extend your, for want of a better description, your personal allowance with that amount. So if you've borrowed 50,000, you're paying back 5,000 in interest. Instead of having perhaps £12,500 worth of personal allowance, you're equating it to £17,500 personal allowance, which also means your company could pay you interest in return, and you're not going to get taxed on it. And of course, interest being paid out by your limited company is indeed a tax-reducing expense, which potentially could bring down your corporation tax. And it's a win-win in the sense that you're bringing down corporation tax, but you're not conversely raising your own personal tax. Now, a lot of care needs to be had. You need to really go and understand the conditions and make sure that they genuinely apply to your situation. But it's definitely something worth going and having a look at. Definitely a better solution than trying to load it as a mortgage expense against your property portfolio.
Perfect. And nothing more to add on that point. Brilliant. So let's move over to Dilip. Let me just see Dilip saying, okay, so let's just cover this off. Hi, everyone. What is the best way to transfer shares to children in a newly incorporated property company to minimize inheritance tax? What is the yearly allowance? Now, that's an interesting one because anyone that's got a limited company, you will have shares. Now, the disposal of those shares or your gifting to family members will still be subject to capital gains tax. And as a basic rate taxpayer, you'll be paying 10%. As a high rate taxpayer, you'll be paying 20%, but you do get £12,300, which is capital gains tax exempt each year. So you could transfer £12,300 to loved ones without any CGT at all. Any comment beyond what I've just said there?
The one thing I would add is that you need to be careful that if you are either securing loans already in that company or about to, or could be doing so in the very short-term future, most commercial lenders really don't like children being shareholders in a business. They really don't like it, to the point where the moment you involve children in terms of owning shares, even if those shares give the children no voting rights at all, you may find some lenders step away from the table and won't work with you. And those lenders that will remain at the table might suddenly put their rates up. So you need to be very careful, and there's a balancing act here between mitigating and planning for inheritance tax minimisation and enabling you to get the loaned money you need to grow the business to make it worthwhile to minimise inheritance tax. So there's a real balancing act here. Some lenders will consider children being shareholders, but they may have a very stringent cap on the volume and value of shares those children can own. So before you make any steps to perhaps handing over or gifting shares to children or anybody else in your family or friends group that you wish to give shares to, just go check the implications of what it means to any loans you already have or any future loans you're thinking about getting.
We're just having fun and games with the HS340 because people are saying it didn't work. And
oh, really?
They're quite right, it did work. So I'm just going to go over back to my chat box to see if it worked this time around.
There's so many people trying to get on HS340 now. It's probably fallen over.
No, you wouldn't say things like that. Let me just try that again. So hopefully that's come up. So thank you ever so much for pointing that out. I have done it again. I think that's a good answer to delete. I think the other thing to think about is, well, did you mention trust? Because I was focused on that. Okay, so rather than using your capital gains tax allowances, you could use your IHT in a very complex way, but it's achievable to use your inheritance tax plans instead, because capital gains tax allowances, 12,300 in a couple, 24,600. Isn't my maths great? Where inheritance tax allowances, you get 325,000. I'm going to show off 650,000 for a couple. So you could transfer all of that money over to your children, but there are a lot of steps that you have to go through on the latter option. But it's certainly...
And again, lenders may not still like a trust being an owner in your company. So horses for courses here. Go and assess what the best solution is for you and how you'd like to maybe transfer money over or share ownership over to children or into a trust for children. And the important thing is go talk to your lenders and make sure that you're not about to fall foul of some voiding condition that makes them knock on your door and demand their money back within a month, because they could do that.
I've got the gremlins going against me. So I'm just saying to everyone, Google HF. So here we are. So if you're watching and you're saying, well, my links aren't working, I'm copy and pasting from HMRC, but I'm getting this page not found as well. So just Google HMRC 340 as the link is not working that I've just offered. So do a Google search. It will come up for you, even if it didn't come from it for me.
It might be that they're updating some documentation in the content and it might be offline. I've not seen that before, but it could well be.
Yeah. Let's have a look at this one. Joe Billingham said,
Joe.
Hi, Joe. What are the tax benefits of having service accommodation? Ooh, it's many, isn't there?
Well, you need to be careful what service accommodation means. That isn't a phrase used from a tax angle. The tax angle is a furnished holiday let meeting help sheet 253 conditions. There's another HS253.
Yeah, but hold on, Louise, hold on, because these property gurus out there, They all call it service accommodation because for marketing purposes, it sounds very new and sexy.
Well, I think of SA as being self-assessment. So quite frankly, there we go.
Yeah.
HS253. Yes, HS25. I'm now questioning myself. HS253 gives you all the conditions that you must meet in order to benefit from what's described as furnished holiday-let tax reliefs, including the access to capital allowances, potentially rollover relief if you were to sell the asset and move the asset's valuation or capital sale value into a new property of a similar ilk. You might get out of having to pay capital gains tax at that point in the process, although not forever, sadly. And a small number of other massive benefits, quite frankly, in your personal name, including Section 24 being something you can kick out that door. So if you do meet some of those conditions, or all of the conditions, particularly in HS253, then great opportunity.
Yeah, that's a good one. Okay, let's move on. There's some good questions coming in tonight, actually. So let's have a look at this one. So Stevie says, is it okay to have a JV between... Oh, okay. So this is another one that we spoke about before. And again, what I will do is from this is just type in something that I think, Steve, you ought to be looking at as well, which is HMRC. So that is
It's a great question. Unfortunately, there's a relatively unpleasant piece of legislation called General Anti-Abuse Rules, also known as GAR.
It's not very GAR, is it? It's not very GAR-like. It's almost like I feel like I'm a dentist. GAR.
Oh dear. GAR is not a pleasant piece of information. What it says is that you need to be using the tax legislation, the laws, in the spirit they were designed, and you shouldn't be looking for loopholes or identifying ways in which they could be used but was never intended. Sadly, things such as renting a property to a limited company that you own in order for the company to pay at corporation tax, which could be significantly less than what you're paying in your personal name, is not a solution that we feel falls in line with the way that GAR wishes the law to be treated. So consequently, trying to do what I'll call a rent-to-rent, and forgive me if I'm using terminology that isn't quite what you meant, but for us, Steve, that kind of thing really isn't something we would encourage any of our clients or any of our tax clients to be considering, because we feel that there is a risk that GAR could interpret that very badly.
Yeah, and just to go on from that, we still are seeing from our tax advisors are still seeing. There's abundance of 2018 HMRC brought lots of legislation to almost pretty much make sure that, as you said, the everyday person doesn't get tax disadvantaged by you using a company in this way. So there's things like, even a YouTuber I've seen talk about 15 to 20% charge to a limited company. And that's absolutely fine if you are a genuine letting agent, whereby you've got people working for you who manage your properties. Then that's generally a commercial relationship, not a tax dodge in the opinion of HMRC. So you can do, I've seen things people talk about deed of trust to a limited company, but hold on a minute. Deed of trust, that's a transfer of beneficiary entitlement. Beneficiary entitlement means capital gains tax. Oops. You've also got SDLT to think about as well. So that's another trip up, yes, which people don't realise. Then you've got the management company or rent to rent, as Louis said, but then that's a tax disadvantage. So GAR hits you with that as well. And then you've got this 15%, but again, HMRC will look at that very stringently and say, well, who's managing these properties? Oh, it's you. Well, therefore, it's your money. The fact that you're trying to use this, and people say, well, even our clients are saying, why would HMRC look at me? Let's just count back to all the tax dodgers that have been in the recent times. And people say, well, no one's been caught by this, so it's not going to happen. Let's talk about it. A famous comedian, yeah, in terms of doing some offshore loans and stuff like that.
Film businesses.
Putting IR35.
All manner of
LLPs,
in LLPs.
Using Ferraris and LLPs. Yes, a very famous property guru did that. Good luck in court when that happens, son. But there are many, and I think what will happen is that HMRC won't attack landlords using this GAR straight away. An example, IR35 came out a long time ago. I'm talking 15 years ago, probably, if not more. I was a consultant and I saw IR35 and I thought, well, I need to do something different. So I started this business up because I didn't want to get caught out. And no one got caught out for the first 5, 6, 7 years that it was running. All of a sudden, HMRC saw all these people using this tax construct and said, we've got enough to go at now to hiring specialist tax people to attack those people using it. So, you may not hear anything about GAR for landlords being an issue. But why would HMRC attack it now? There's not enough fish in that sea. But you wait until another 5, 6, 7 years, and I think there'll be enough to go at and then start attacking people. We've got clients on IR35 who have left the country, who have gone bankrupt, who owe over £300,000 in tax.
Well, they've had to leave the country because they couldn't afford to live here any longer. They had to pay
Families are split, divorce cases. Do you want this on you just because you can get a bit of a cash win now? I don't think so. Just be kind of mindful with all this kind of stuff that you could get yourself a short-term benefit for real long-term pain. So anyone and let's
be honest, HMRC have quite a lot of money to recoup for the government, don't they?
Yeah, they do.
And they've only been in the newspaper last week at being described by the government and members of Parliament as soft. They're not going to react well to that.
Yeah, so I think I have to get a question which I'm going to come back to because it's someone asking. So David is asked the question about mortgages, which will be a good time to kind of get our guest on board with that. So I'm going to just answer a couple of questions that I know people have asked before Simon comes on board. And I think we've answered a couple already. So let me just make sure we've done that. So let's just go over to this one. Is that refinance? No, that's not, is it?
No, it's not.
We haven't answered that one yet, have we?
I don't think so.
So let's just answer that. My screen always disappears suddenly. Okay, so let's have a look at this question for a start.
Hello, Lynn.
Hello, Lynn. So is it worth considering moving a commercial property from my own name into a limited company, as currently down values recent finance by 550k from what I paid for it in 2007? And the big question for me is, what benefit? Because for me, a commercial property, Section 24 doesn't affect you. So mortgage interest, or you could write off all your finance costs against that commercial property.
And Lynn, just so you know, we are assuming when you say commercial, you mean something that isn't residential, isn't a HMO, probably isn't a furnished holiday let meeting HS253 conditions. Hopefully you haven't Googled that and found that one isn't working. But it could be something like an office or a shop or a warehouse or a factory.
Yeah. But the other side to that is if you're a high rate taxpayer, then it might be worth you transferring that property into a limited company. The big thing on that is that you will have this instance of paying stamp duty land tax because you're transferring from your own name. And because you mentioned that you bought it in 2007, there will be a capital gains tax as well. So you're almost having to weigh up the disbenefits, the cost, if you like.
Equally, Lynn is saying that it's been downvalued at the recent refinance. So I'm guessing, Lynn, what you're meaning by that is that its current valuation is 50 grand less than when you first bought it.
If that's the case, then it won't be so much of a capital gains tax issue. But if it has increased, but the finance has been downgraded recently, that's what I'm thinking, then you might have a capital gains. But it is always, anyone listening, talking about should I transfer a property from my personal name to a limited company, always think about the long-term advantages from a tax perspective versus the cost of moving it to that limited company. Stamp duty land tax, which is the purchase cost, transfer, and the legals, and the capital gains tax that goes with it as well. The nice thing about capital gains tax for this one is the fact that you have the 10% rate for basic rate taxpayers and 20% for high rate taxpayers. So that can work out for you. Now, I know that Simon is waiting in the wings, so I'm going to make him wait just a little bit. I know, but Simon looks at me and smiling. I can see him smiling. He might not see it, think I can see it, but I can. So I'm going to just fire these questions as it is. So let me just go through these questions. So Max.
Hi, Max.
Max is a constant person that loves this show and comes on it. So Max, welcome back. I'm living in Hong Kong currently, and I've bought a phone/computer. in Hong Kong on Amazon US solely for my property business. Can these reduce my rental income tax as an expense as an individual or a company? I would say straight away, more so in a limited company whereby you've got these assets being used, where you've got your property portfolio inside a limited company that legitimately could be used, a phone or a computer. You can claim it as capital allowances and it would reduce your capital amounts. In your self-assessment, is it so easy?
It depends. I think the answer is still yes. There's always a yes and an and, though. So if you are utilising those pieces of kit, not just for your business of property in the UK, then I wouldn't recommend that you attempt to claim the full value of them. I would recommend that you claim a portion of them that is commensurate with how much of them you use for your UK business versus other things. If, however, and I do have clients like this who happen to run a portfolio, for example, in their personal names, but they happen to have a work computer, as they call it, and a work phone, and at the end of their day working on their property business, they put those things away in the office drawer, lock them away, and then they get them out the very next morning and use them just solely for business, and genuinely it is just for the business, then yes, of course, you can claim 100% of those expenses because they are legitimately used in your property business. But just be careful that you're claiming a portion, and the portion is a fair and reasonable amount based on your business use of it, if actually it's used a little bit for business and a little bit for home, or vice versa.
I'm going to quickly get Simon on, but Simon, just bear with me a second because I'm just going to get these two questions answered, and then we'll go into the buy-to-let finance arena with you, good sir. So we'll get you on. Now, Sushila.
Hi, Sushila. I think we've seen you before.
Sushila, on the last show, in fact. Yeah. So welcome back. Can you claim capital allowances for service accommodation? Now, you must have been.
Word again.
Yeah, you must have watched it.
That's what SA stands for, surely.
Yeah. So service accommodation, furnished holiday let. That's what he meant. But service accommodation is it's furnished holiday let for anyone listening, thinking, what are these two guys on about? But FHL. Service SA, same thing, right? So can you claim capital allowances? So Sheila, you should have watched us last time. I think you was on a show with Jake Illis or Jake Ills.
Isles.
Jake Isles. Sorry, Jake. If he's watching again, he'll kill me for this. But you can claim capital allowances, and it will help you reduce your income tax liability as well. The fact that you get this mortgage interest relief as well, which means that Section 24 does not affect you. You can write off 100% of your finance costs against your rental income. Now, as a reminder, Louise, why don't you just share with everyone what the criteria is for furnished holiday lets people for when they're doing their self-assessment tax returns?
Okay, you've got your pen and papers ready? So the first thing is you must make it available to let for at least 210 days per tax year, or for the first 365 days, assuming it is let not exactly at the beginning of a tax year. You must then rent it for 105 days on lets of 31 nights or less as a minimum, and you mustn't rent it out for more than 155 days in a tax year, or the first 365 days on lets of longer than 31 nights. Have you got that? Those are the starter criteria. You obviously need to make sure it's furnished as well. That's what furnished holiday lets are. And it's got to be sufficiently furnished for somebody to use it as a home effectively, whilst they're residing in it for their holiday or their serviced accommodation needs. And there's a small number of other criteria. Do go check out HS253 because you really need to make sure you're meeting those criteria.
And interesting enough, I've just shared that out as well. Excellent. And I've just checked it as well. So that link works. The link for HS340 didn't work, even though it's in Google, and I could get that up and live. Amazing. Is bizarre. But that's technology for you.
Can we bring Simon on now, please?
Not
He's been
yet.
Waiting very patiently.
No, he can wait. No, come on. This is really important because this is just a funny question, and I have to answer it in the most humoristic way I can do it.
Hi, Tolga.
Tolga has asked advantages of LLC against Ltd companies. Now, I'm here thinking, hold on a minute, I know what an LLC is, which is an American company, and an Ltd is a British company. So what's the advantages? Well, if you're in America, use an LLC. If you're in the UK, Tolga, use an Ltd.
I do apologise.
So that's it. Job done. Right, bring Simon on. Let's move on.
Let's move on. Let's bring on.
No, we can't do that. That's
Simon.
unfair. Let's finalise this, Pete. What Tonga might have been thinking
LLP.
about is LLP, Limited Liability Partnership, which is a UK company, but there are no tax advantages because the tax of LLPs are in your personal name. The Ltd Limited Company is the only one that has corporation tax benefits. Okay, so just bear that in mind whenever you're thinking about it. Typically, I see LLPs being used by accountants and solicitors because they want this corporate veil, which is an American phraseology. But since you said LLC, I thought I'd throw that in there. So you have this corporate protection, UK speak now, which could be quite useful if you are in the professional services arena. Are you smiling?
I'm just thinking that the British version of corporate veil would be a corporate net curtain.
Oh dear.
I don't know why I thought that, people. Sorry.
Yes, so post my in the chat. Hoping to. Paul, if you ask a question, I will be coming back to questions because I've just got to whiz through them to find out which one it is. But I need to bring on my guest now.
2 Simons in the room, people. 2
Simons.
Simons.
Who would have thought it, hey?
Hey.
Good evening, Simon. So why don't you, because there is this other famous show, I don't know if everyone's heard about it. Most people would have done, the Property Expert Panel.
Oh, here we go.
Which is live on the first Monday of every month, so which you will see the brilliant Simon in that show as well. But for the people that haven't watched that show, I mean, who wouldn't? I don't know. But why don't you introduce yourself, Simon? What is it that you do? Your name, your company, etc.
Okay. So my name's Simon Hodgson. The company is funded. We are specialist mortgage brokers. I started out sort of investing in property over 20 years ago, and worked out that the average broker wasn't really much good as helping an investor invest. So yeah, that's kind of why I do what I do. Effectively, I've invested in that time. I've learned how to lose it all through the credit crunch. I had to build some back up thereafter. And that's me. So effectively helping people to recycle their cash, use new and obscure lenders, not overstep the mark, but find ways that lenders will allow you to push the boundaries comfortably to get you to the kind of mortgage you need, but they weren't necessarily advertising, etc.
And anyone that wants to get in touch with Simon about mortgages. Now, just notice I'm echoing through your screen here, Simon, so it just might be worth us muting each other as each other talks, just in case there's a bandwidth issue. But for anyone that's looking for a buy-to-let mortgage, there is a link below the YouTube video description. Okay, so go onto the YouTube video description and there'll be a link. That will help Simon understand what you are looking for. So we'll ask you some questions, but it's useful so that Simon is armed and ready to help you with the right level of information. So hopefully that's covered us off with that one. Let's get straight into these questions. And Simon, this is a bit of technology that you've not seen on the Property Expert Panel.
He's very excited, Simon, with this. He loves it.
Astounded. I mean, I've been waiting in the wings, marveling, because usually, Simon's quite slopey-shouldered when it comes to tax questions on the other channel.
Yeah, well, that's because
don't encourage him, Simon.
We're trying to bring them onto this show. That's why. So let's go through it. So David has asked a question, Simon. So how difficult would it be for my wife and I to get further mortgages once we are applying for our 5th and beyond buy-to-let mortgages, as we will probably achieve 50k income at 9 buy-to-let properties? So obviously that's scaling because it talks about 5th property, then they're talking about 9 buy-to-let. So I think there's a step up. But what's your views on this one?
Okay, well, David, I don't think we see you on our other channel, but this is a really common theme in that it sounds like I'm going to make the assumption that you're buying or have bought these properties in your own name and you're mortgaging them with vanilla buy-to-let lenders at the keenest end of the rate spectrum. And as you go into the 5th and more, you become a portfolio landlord, and it might be that you're looking at slightly more cash flowing strategies, maybe service accommodation or HMOs. And those mortgages are a little bit more expensive, but will cater for those next level of purchases that you're doing. It does get a little more difficult if you're looking to keep it in your own name in terms of passing lender stress tests. So yeah, generally, I think what you need to do is it's a two-pronged attack in terms of working where your tax liabilities are now, where they will be as you buy further properties, and then me sort of kind of plugging in the background and kind of go, right, okay, well, it now looks as if you're ready to start buying maybe in a limited company potentially, and utilising lenders there. There's a slight rate penalty. I can't deny that. So it's a case of working out whether that rate penalty is worth the saving of putting it into a limited company. A long answer, I feel.
No, I think that's a good answer. I think the other side to that, though, Simon, is you and I talked about previously, whereby the rates might be different in a limited company versus personal. But that's not always the case, is it?
No, it's not. I mean, did you want me to summarise very quickly, or?
Please do.
Okay, right. So if you're buying a single let property, put it in your own name. I'll compare rough 2-year fixed rates at the moment. If it's in your own name, you might access a rate around 1.79. If you put it into a limited company, that very same property with the same level of mortgage on it, it will attract an interest rate between 2.49 and 2.89, depending on which lender it goes with. Exactly the same property, exactly the same size mortgage, no different. However, if you're then looking to do slightly more sophisticated strategies, you're doing serviced accommodation or HMOs, those mortgages are priced exactly the same or virtually the same as limited company mortgages, and there is no differentiation between the cost of those two. So then it becomes a lot easier to decide whether you want to put them in a limited company or your personal name. Or if you're buying both, potentially you can mix it up, put the single lets in your own name and get the benefit of the better rates, and put the more esoteric strategy ones into the limited company and run the two together.
How do you spell esoteric?
Oof.
By the way, just David has said, yes, I'm on the other channel as well.
There we
are.
are.
So
that's good.
There you go. So that's put pay to you. Right, let's get to some of the other questions that we've got as well, which I think this is an interesting one. I do want to talk. I'm going to mute you for a second, Simon, just because there is this echo. But unmute yourself.
You can't mute me.
No, you can't. But so here's a question. I wanted to know if I could set up a declaration of trust to add my wife as a beneficiary interest so that she can claim rental income. If the legal ownership doesn't change, am I still liable to stamp duty land tax? And that's an interesting one. So let's talk about. We'll bring Simon on because there is an interesting point here. But benefit. What's a deed of trust, declaration of trust in your eyes?
So a deed of trust in its simplest form, and forgive me please, any lawyers out there with my oversimplification. What it enables from a tax angle to do is for you to share income in a way that is not necessarily commensurate with the original purchase process. So as an example, you may have bought a property in your personal name, subsequently got married, now renting it out, and you may choose to share part of that property with your new spouse. You might use a deed of trust to enable that movement of ownership or part of the ownership across to your spouse.
I'm going to bring Simon on board here now because from my perspective, in fact, I'll let you test your own mute and unmute, Simon. So hopefully you can see that. It should be on the middle pane. Look at him. I can see him sweating. I can see him sweating.
No, he can't do it.
Can't.
You do it, Don.
Okay, I'll do it. But no, I wanted to see
You are rotten.
It's nice putting through it as usual.
Such a troublemaker. Sorry, Simon.
Stamp duty land tax, because there's a benefit. Do banks like deed of trust, first of all, Simon?
Sorry, Simon, can you repeat that? I tell you why. There are, for you lovely, lucky people out there in Marbella, you're not experiencing 40 or 50 mile an hour winds going past the window behind you.
Oh.
Right.
I didn't quite hear you.
No, don't worry. So a deed of trust is whereby you transfer the income. So let's say that a wife has got all the property income in her name. She wants to use a deed of trust to transfer, let's say, 50% over to her husband or 99%. Now, they may not go on the mortgage, but do banks like that, or
no?
A demand.
If both people are on the mortgage,
it won't be though. It'll be just one person.
No, if it's just one person, then you are effectively signing away some or all of the beneficial interest in that property. And in 99 out of 100 mortgage deeds that you sign, it will say in the T's and C's that you are not allowed to sign away the beneficial interest, or you need to seek permission to do so. And again, 99 out of 100 times, the lender will go, no.
Yeah. Why is that? Is it down to risk?
Perceived risk. Because the idea is that specifically on a buy-to-let product, that the lender, under Prudential Regulation Authority underwriting guidelines, need to make sure that there's enough rent coming in to pay the mortgage payment. Now, if the mortgage payment's going out of your account, Simon, but Louise is getting the benefit of it, technically you are not now receiving income enough to pay the mortgage. In its simplest form. Okay, you're married, but yeah, that's kind of the way this. There are many other ways that underwriters will also see it. I've had this conversation with many an underwriter over periods of time. They just don't like it.
Yeah. And therefore, if you have to use, I'm just going to mute Simon as well, just for a second. But whilst that's happening, then of course what you have then is another issue whereby if the banks are asking you to transfer the debt, that is consideration, and therefore stamp duty, land tax will be charged on you. Which, if you got a property at 100,000, you think that's not an issue, but you have to think about, well, hold on a minute, you've also got the 3% SDLT as well. Does that come to effect? Now, it doesn't. It shouldn't do, but there are a lot of solicitors who will just ignore the law, dare I say, and just basically charge you the maximum rates.
Or misinterpret it, quite frankly.
Yeah, they misinterpret it, and they use the normal stamp duty land tax calculator. So you can be quite off-putting, really, by using them. I'm just going to go to some other questions, actually, and just see if we can talk about... We've done this question, haven't we?
We have.
We're going to ask that one.
There's a great one a lot further down, actually, I think.
Well, I think
we're picking juicy questions, Simon, I promise.
I do want to pick up this question, actually, so I'm with you. So I'm just going to put that in, and then we'll put that on the show. So Amelia's asked the question: can buy-to-let be changed to SAs at time of remortgage, and do I need to inform HMRC prior to change on the self-assessment? We'll come on to the tax position in a second, but Simon, from a mortgage and practicality perspective, a buy-to-let mortgage is not the same as a service accommodation or furnished holiday let, is it?
No, absolutely not. So the two are priced ever so slightly different. A standard buy-to-let and a service accommodation mortgage, they are different products with pretty much every lender out there that I can think of. There are a couple of obscure building societies that have got standard variables that might offer a similar rate or the same rate. The right time to change it is at the point of remortgaging. However, I guess I would stress that if you have looked to run it as service accommodation before that remortgage, be very careful. Modern underwriting, goes on the internet and goes on Google and will search the address. Now, if they can already find that your address is listed with Booking.com, etc., 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 but they knew, or they can see it's on a standard buy-to-let mortgage, you might find there are some awkward questions coming from that underwriter, because clearly you have contravened the T's and C's of your current mortgage and your current mortgage provider, and would they like to take on a client who might have done that? Possibly not. Need to be really careful, I think is what we're getting at.
Perfect. Okay, I'm just going to put you on mute just for a second because I just want to get rid of this echo that I can see in the background. There is a question that is coming through from Anna, and I'm just going to put this into the show as well. So let's go through this question. That's good. I've noticed that now we've done the split screen, but it doesn't cut us off up to our necks like this. It's like we're looking over like Penfold because he's too small.
He's never
over a brick wall,
Simon, than when he's playing with his technology.
Yeah, so Simon knows that though, so it's fine. So Anna has asked the question: looking to buy a limited company which holds one HMO to save on stamp duty. Now let's cover that off because that's an interesting one. We'll talk about finance in a second because I've never really understood the finance aspect. So it'd be interesting to see Simon's viewpoint. But why do people buy? What's the difference if you're buying a property or a company, what is the purchase tax in each scenario?
Well, they both start with the word stamp duty, but if you're buying in a limited company, that's where it ends. If, however, or rather you're buying a limited company, if, however, you're buying a property and it's basically owned by an individual, so you're buying it from them, whether you're buying it into a limited company, a partnership, or your personal name, then you're going to pick up stamp duty land tax. And there are some very specific differences, particularly in terms of value. Stamp duty is a much better price, shall we say, for the average buyer than stamp duty land tax. It's typically 0.5% of your purchase. And I use that word carefully because there are nuances on what it is that you're paying. The lovely thing about that, of course, is 0.5% is an awful lot less than most stamp duty land tax charges you could pick up, even if you ignore the 3% additional rate and the 2% foreign rate. So it's a much more advantageous tax position to be in at the first purchase of an asset.
Which has big things. The thing I would say about limited companies is you don't know what you're buying. With a property, you can go around the property, you can see, you can kick the walls, you can see if it falls in.
Didn't.
Yeah, imagine that. I just put a hole in your floor. I do apologise for that. I don't want to buy it. That'd be an interesting conversation to be had. But moving from that, so you can physically touch a property. Again, wash your hands before you do that. You don't on the white walls. But on the company perspective, you've got to do due diligence, and you've got to look at what the liabilities have been. Are there any lawsuits against it? Are there any charges against the property that you're not aware of? Are there any commercial agreements that span several years that you will then have to pick up?
As well as HR implications and VAT implications and supplier implications. There could be all sorts of issues lurking in the dark corners of that limited company.
Dark corners, that's
and
quite sinister.
And you are buying the whole lot. So you need to be careful.
So yeah, I think as Louise says, it dark corners. You have to peer through those dark corners.
Get your torch out.
To get your torch out, to shine a light on the limited company and expose, see what I did there, the due diligence process, which can take a lot longer. So you might save stamp duty land tax, but are you uncovering risks later on down the line? So you will need to get a solicitor on board. You need to get an accountant. We don't do any of this work, I have to be honest. But
there are specialist forensic businesses out there who can.
Yeah, but they charge about $2,000 for due diligence on a company. So you might save stamp duty, but actually not so much on this. I want to bring Simon into this though, because Simon, if you're buying a property, we know you have to go through a mortgage application. But if you're buying a company from someone else,
that has a debt on it already.
That already is a debt, and you're taking that debt on. First of all, will the bank want that repaid before the transaction takes through, or will they allow you to take on the debt itself?
Right. There's not a straight answer to that. So first of all, a lot of it's going to come down to all the points that you just made. So what that absolutely tells us straight away is that a vanilla buy-to-let lender, your BM Solutions or TMWs or really keen interest rate limited company lenders like Precise, absolutely won't be able to do it because they don't have the underwriting prowess or skill set to be able to work out what are the risks of the company, how do we mitigate those risks and underwrite it. So it will largely depend on who's lent on it at the moment as to whether they will do it. And then what those risks are, because there are other risks. Potentially that HMO started out as a single let property and had a conversion, and the building works were carried out by the limited company that owns it and paid for by the limited company. Now, did they do an asbestos survey prior to commencing the work, or was there asbestos on the site? And in the future, you might well have an asbestos claim. It's really, it's not very likely, but again, it's one of those obscure risks that you cannot mitigate, or you can mitigate. You'd have to take out an indemnity policy, but that's why the likes of vanilla buy-to-let lenders just can't cope with it. So it will come down to who the lender is and whether the lender will allow it. And effectively, what they'll do is underwrite the new director and shareholder, and then there'll be a reissuance of paperwork and probably or possibly a new arrangement fee to take into account that new set of work that's been done. which might be as much as the stamp duty you're about to save.
Yeah. So there's quite a lot of downfalls, I would say, on that. I'm just going to mute you for a second, Simon, but I do think there is some benefits of buying companies to save stamp duty and land tax. And from a marketing perspective, I will do videos on it because people love saving money, but actually it's the hidden costs that you have associated with buying a limited company. And it may not be that much of an advantage to you by the time you finished it, if I'm totally honest with you.
In fact, I would say probably of the recent conversations we've had with our clients looking at buying a company that already owns either an asset or several assets, I would say 1 out of the last 5 have actually proceeded in that way, simply because of the scale of risk and the extra expense it would cost them to complete what they consider to be appropriate due diligence to give them the comfort they are buying what they think they're buying. And that's the big issue.
Oh. So Tiago is also a great question. Tiago, good evening.
Hello.
So, hi all. If I get a buy-to-let mortgage, do improvements to it, and decide to sell the house after a year, having in mind improvements done, and the current seller's market, will the lenders not like it? Simon is already smiling. So, Simon, why don't you tell us what your answer is through those gritted teeth?
Wow. Well, this is a hot topic, isn't it? So, if the clue, I guess, is in that first abbreviation, BTL, buy to let. So the lender has lent money because you have told that lender that you are buying that property to let it out. Yeah, it's then underwritten it with Prudential Regulation Authority underwriting guidelines that they've assessed that there will be money coming in order to improve affordability. You potentially have carried out works. Now, if you've carried out a really simple refurbishment, wall coverings and floor coverings at the end of a tenancy to sell it, that's really not an issue. However, if you have done kitchen, bathroom, floor coverings, wall coverings, some stud partition walls, yeah, you clearly have bought a wreck that you managed to sneak past the valuer and the lender first time round, and are selling it at a significant uplift that isn't part of a normal gains through the property market at the moment. Is that lender going to not like it? Well, yeah. It's called. Well, what you meant to do is take out a short-term loan, a bridging loan, rather than a buy-to-let. But if you fall into this particular situation accidentally, you could ask the lender. Yeah, I've come to the end of my 6 months tenancy. I'm thinking of selling the property. Before it goes on the market, is it okay if I carry out some refurbishment? Chances are they'll be all right with that. But if you ask to carry out the refurb day one, once you've just completed, no. And you shouldn't do that, really. It's technically called mortgage fraud. I think to put a fine point on it.
No, it's a good one. I'm just going to go into some other questions now. But if you're listening live and you have some questions that you want to ask from a mortgage perspective or indeed tax, then feel free to post it. But we have got guests now, so let's make this more towards the mortgage side.
One last thing for Tiago, if I may. Just be very careful, because when you're selling a rental property at the end of the life that you wish it to run for you and your portfolio, most situations trigger capital gains tax. However, there are now situations where HMRC are investigating short-term purchases, such as you've identified could be a case for you. And instead of it being under capital gains tax, it's now under a whopping income tax and national insurance. That means if you're a high-rate taxpayer, you're on the tight hook of 51% of tax when you add together the income tax bill and the national insurance bill. Be very careful what you're thinking about doing and how you're going to go about it.
Now, I've had a look at YouTube. We've got 22 people watching. We've got 1 like.
What?
And that came from me.
Only 1 like?
That came from me.
That came from you. You've liked
I've
yourself.
liked, of course I did. I like what I say.
Have you
I'll
heard
say
this,
what
Simon?
I like and like what I say. There you go. That's a famous expression if I've ever heard one. So please, if you are watching this, please do smash that like button. Don't put a thumb on, a nice emoji. You're not looking for that. Looking for a nice smashing of that like button. and are hitting correctly, beautifully on that subscribe button as well, so that you don't miss any future videos that we do.
I do
So
apologise.
there you are. So
There we go. Got a lot.
I'm
There we
going,
go. We've got
Amazing, Simon.
yeah.
just there.
All
Thank
right.
you.
So I'm going to test that. Right. So if I get rid of it, I'm going to just go straight to this live show, and I can see 12 likes straight away.
Amazing. Thank
Perfect.
you.
Okay. Thank you ever so much, everyone. So the question that came up was an interesting question. I'm going to go back to it because I know, Simon, you're a landlord yourself, so this kind of will fit your bill. V&V Walker said, how hard is it to grow your portfolio if you don't have a job? And that's where I want to bring you into it, with a significant rental income coming from existing portfolio. My question to you, Simon, is this: if you are a full-time landlord, or you are a full-time self-employed person because you don't have a job, does that mean that you cannot get a buy-to-let mortgage in your own name anymore?
Definitely.
I've just muted you. Sorry, you're going to start.
Oh, look at that. Hey,
You meant to move it
Freudian slip of the finger. I've just muted you, Mr. Hodgson.
I hope the BBC producers aren't watching. That was a massive fail. Mind you, I am going for a broadcaster, not an editor, so that is definitely a different role.
No, it doesn't affect you. Okay, so there are some lenders that have got minimum incomes, and that might be 25k, 30k, combined income of 35k. But there are enough lenders out there that don't necessarily have minimum incomes, where as long as we can show that you have an income, that we can do what you need to do. And there's a bit of an assumption on my part that as an investor, you're probably looking to momentum invest, remortgage at higher values. So those kind of lenders are already well versed in working with landlords who don't necessarily have easy to prove or large incomes. So as long as we've got an income, you filed the tax return, then we're all good.
That's a good answer. We'll move on from that. So here is a bunch of questions that I'm going to fire your way. And anyone listening live, please do get your questions in, and we'll pose those to Simon. So Donald has asked, how many buy-to-let mortgages can you have?
Right. Well, depending on which lender, it can be relatively infinite. So there are some of the more, again, vanilla buy-to-let lenders will max you out at 10. Some are 5, some are 4. But there are lenders out there that will go to 30, 40, 50.
Because there was this thing I heard, I'm just going to make you sorry quickly, Simon, but I heard that when it comes to people having 4 mortgages, that the level of application you have to go, you almost need to write a business case. I've also heard stories about the level of interest that you pay is significantly increasing as well. Can you demystify that and provide some truth?
Yeah, so effectively you are now known as what is deemed as a portfolio landlord when you get your 4th mortgage. It does knock out some of the vanilla buy-to-let lenders at the keener entry rate spectrum, but there's still plenty out there. So from 4 to 10 is relatively easy to do, and you could still do that in your personal name without too much difficulty, but obviously tax-wise it might not make sense. Once you breach 10, it definitely is pointing you in the direction of a limited company, but there's plenty of lenders out there to do it if you know where to look, to be fair. Maybe I'm oversimplifying that, because that's my kind of what I do, bread and butter, day in, day out. It's relatively easy, but I guess if you're a residential broker, it's not as easy because you don't know what to do. You might be muted at your end, Simon, possibly.
I muted the wrong person again, haven't I? Oh, dear. I'll be on Channel 5. I'll be demoted. So anyway, moving on from that, if you have got a certain number of mortgages, would it be then good time to move to a limited company, because it can be heavily scrutinized and you don't get the good offers in your own name anymore?
Yeah, that's definitely a good point at which to look at where you are in terms of tax perspective, income spectrum from lenders that are offering you mortgages, and make that jump potentially.
Okay, perfect. So here is another question coming your way. So let's go answer this question here. So Daisy,
Hello, Daisy.
as how much deposit do you need to put in a buy-to-let mortgage? I mean, I've heard varying rates from 10% all the way to 50%. What I guess there is this. Let's talk about the I'm just going to put you on mute because I can hear myself. But thinking about the condition of the property, thinking about the person with a better credit history, maybe thinking about different circumstances that might require you to put in more of a deposit, and then again think about interest rates if you don't mind. Then going to the other side of the spectrum, whereby it's a high yielding asset. The person has got a very good credit. Talk to us about levels of deposits and interest.
Okay. So deposit levels tend to be sweet spot for most lenders is 75% loan to value. If you are a first time investor or a first time landlord, typically you are going to get restricted to 75% loan to value and no more, so that the risk level is managed for the lender on the lender's behalf. It's possible to push it up to 85% on a buy to let mortgage. But the rates do creep up. So there's a bit of a payoff there in terms of, yes, you've minimized your deposit, but you are paying a higher rate. And generally, if you calculate it out over a 5-year period, you almost pay back all of that additional money that you saved in deposit at the beginning in interest back to the lender. They've got algorithms, they know what they're doing, to be honest, to get their money back. If you've got a slightly credit impaired file, typically the main thing a lender's going to do is, first of all, charge a slightly higher interest rate. They might restrict it by an additional 5% loan to value, so we might get knocked back to 70% loan to value. Those will be the most likely things, and it does knock out a number of lenders in terms of the best rates, that's for sure. If you're buying a refurbishment, okay, you're now not going to use a buy-to-let mortgage because we've kind of covered that. You're going to potentially go out and get a bridging loan. That kind of lender will typically give you up to 75% loan to value, but they will look to deduct the interest from the advance they give you on day one to buy the property. So make it really simple. Let's say it's 1% a month. It isn't, it's much cheaper than that. But if it's 1% a month and you've got a bridge for 10 months, that's 10% that the lender won't give you. So rather than having 25% deposit and a 75% loan to value mortgage, you are actually putting in 35% day one and walking away with 65% funded by the lender on day one to buy the property. But there are ways around that as well.
Perfect.
Right.
That's a very good answer. Thank you ever so much. So let's just go to Butch. Butch has asked a question. Let's go into the Butch now. Has asked a question: how much buy-to-let mortgage can I get? Now, I think we talked about this. This kind of covers off with the deposit versus the amount of money you get, really, isn't it?
Yeah, well, yeah. There's something else that potentially he's thinking about, which is a lender will do a stress test. So let's say, for argument's sake, your property rents out for £1,000 a month. The lender needs to make sure that your mortgage payment is also not £1,000 a month, because there's no profit in it, and therefore if there were any changes or any voids in the property or any maintenance issues, you now can't afford it from an affordability perspective under the Prudential Regulation Authority underwriting guidelines. So typically they're going to stress it at, and this is where it gets a little bit complicated, but let's say for argument's sake, your £1,000 rent, your mortgage payment cannot really be any more than about £650, so that there's a margin above it. But they will stress it at a notional rate and an interest rate, and typically that notional rate is between 125% and 140% of an interest rate typically set at 5.5. So even if your mortgage is at 2%, they're stressing at 5.5% to allow for maintenance, management, voids, and interest rate hikes in the future.
Perfect. Thank you ever so much for that. Just out of interest, have you noticed the names, Simon? They're not actual names; they are fictitious names. But here's your question, and I might give you a prize. But what are the names that I've been sharing with you? What characters are they from?
Okay, I like that a lot.
They are from Disney. There you go. So I'm going to finish
Protecting the innocent.
protecting the innocent. But actually, this is just a good series of Google questions that people ask, and I thought would be good for the show. So Felicity, which one's Felicity in Disney, in Mickey Mouse World?
I have no idea.
There you go. There you go. So look it up, people, and come back to me if you know. Please type in the comments box who Felicity is, because it's definitely a Disney character in the Mickey Mouse world. But Felicity has asked, I'll probably get sued now, but Felicity has asked a question, can you get a mortgage with a bad credit history?
Yes, but it depends what that bad credit history is. So typically what I have quite regularly happen is people say, I've got a bad credit. I think it's all right. Can you see if I can get a mortgage? So the first thing we do is ask for a copy of their credit file and look at it. And typically what's happened maybe is that they've had a bill that you've moved house, haven't kept up with the bills at the old house, and they've not paid it, but they've not gone back and settled that bill. So they have what's known as a default, which is unsettled. That's pretty hard to get funding against, because what you're effectively telling a new lender is that I run up bills that I don't pay and don't want to pay. Can you lend me some more money, please? And can you imagine what the lender's answer is to that? No, thank you. Rather not, because your track record suggests. So what you need to do is, if you've not paid a bill, is to go onto your credit file, have a look, settle that bill. It might be that you don't want to settle it. I get that, but a default, once it's been settled, is a line in the sand, which then means we can then start approaching lenders and get lending.
Very, very good point. So I shall tell Walt that answer. Okay, let's move over to John, who's got an actual genuine person. But again, an interesting question. At what age can I factor in my children? This will cover both tax and mortgages, so we'll tackle both those. I'm just going to mute Simon for a second, just because I can hear that bounce back. What age can I factor in my children's CGT allowances for developments in my personal names? And if they are school, higher education full time, what will HMRC be using allowances? And it's interesting, John, you should say that, because what you have to be careful of, you talk about property development. So property developments, and I'll come on to Simon in a second about this. But if you talk about property developments, my view, Louise, is that the tax, if you're doing these property developments in your own name, is self-employment, not capital gains tax.
So if by development you mean buying an asset, refurbishing it, developing it, and then selling it, never having rented it out, absolutely, that's considered, in short speak for us, we call it a flip. And that is absolutely self-employment income, nothing to do with capital gains tax.
So saying about your children's CGT allowances for development properties, that's a no-go, simply put.
Well, CGT won't be the tax in which they are charged. However, if you think about the CGT allowances, of course, we all have personal allowances from an income tax angle. The issue you tend to find, particularly when you express that your children are in school, children who are below 18 years of age, there's a nasty piece of law that says if you happen to pay for your or provide your children with an income, as an example, perhaps give them dividends from a company that you personally own, maybe employ them and give them a salary, it will be taxed in your hands as the parent. And you might find that this throws back at you if you were to do a flip and it happened to be in yours and your children's names and your children are minor, then actually all of the self-employment profit, as it will be taxed in your name. And back to my example with Tiago, kiss goodbye if you're already a high rate taxpayer earning more than £50,270 per year. Then you're going to be picking up a 40% income tax bill on the profit, plus the national insurance, which is the self-employed national insurance. So not a pleasant place to be necessarily, and you won't get a chance to factor your children into that either.
I mean, if you've also got properties in your own name and you've got Section 24 impact, even though self-employment income will be there, but you will have potentially 40% tax as a high rate taxpayer plus the 2% national insurance. That's 42%. Or going forwards, 45% if you're additional rate taxpayer. John is added to that.
Oh, and just one more thing, if I may say, higher education. So let's imagine a child's at university, they're securing loans that might be means tested or some form of bursary. If they're now earning money, which of course potentially could remain in their name if they're above 18, because it's not taxed in the parent's hands, you could be putting them at risk of losing either that bursary or the grant or the loan, because it could be means tested as an income.
Yeah, I think the big thing for me is the fact that you are going to get income tax, and people will say, well, because John says flips on the side if my main income is buy to let. And to be fair, John, doesn't matter. You are buying a property, you're disposing it. If you're doing this more than once or twice, you are going to be a tradesperson. Not only have you got income tax issues, but you could have CDM. If you don't know what CDM, do check it out. You'll also have a variety of CIS issues that you'll be, because you are now a developer and you must be deducting CIS 20% tax on your subcontractors. So if you're not, you will be footing the bill for that. So there's a lot of things that you're doing, John, that I would say get some good advice, because I'm seeing a couple of things and I've got to be honest with you, I'm not comfortable with it. So do get some advice on it. The fact that you're doing it 1 or 2 on the side, HMRC don't care about that. How will they find out? Well, it's against your name. They only have to look at land registry and say, well, what's the trigger point? Oh, it's been done in 1-2 years. Oh, they've done that once or twice. It's not going to be too difficult for them to find out, well, actually, that's a flip. Let's charge you tax. From that perspective, Simon, if someone's doing, and this is another thing that I've seen people do, is that they use buy-to-let mortgages when they're doing property developments. Give us your views on that.
And we've
one.
already started to talk about this, haven't we, Simon?
We kind of briefly covered that one earlier. Yeah, you've got to take out a development loan, a refurbishment loan, or a bridging loan, not a buy-to-let mortgage. Your buy-to-let, the clue is in the term buy-to-let. You're buying it to let out, despite what condition it's in. And if you don't, you have effectively lied on your mortgage application. It's more serious for the broker than it is the applicant, actually, to be fair.
Well, the thing about that, though, Simon, was the rates, because on the Property Expert Panel, which is another very famous show, that is the first Monday of every month, which you and I are on, of course. But the actual, you mentioned about the bridge finance interest rate was way below what I used to think. It was 1.5% per month, but way lower now, yes?
Yeah, so for 75% loan to value, I've got a rate of 0.69 a month. If you take that down, I think it's 55 or 60% loan to value, it comes down to 0.49 a month, which is less than 6%. Now, it's not as cheap as a buy-to-let, I get that, but it's not far off it. So the reason for doing it kind of disappears as well and evaporates.
Of course, we're talking about someone that is doing, like John. He might be thinking about doing a flip, but then decides to hold it, or it's not in a mortgageable state when he first buys it. Your take on that is that you should do a bridge finance and then work with a broker like yourself to move very quickly from a bridge finance into a buy-to-let product.
Yeah, absolutely. Yeah. So there are enough few lenders out there that will do a bridge to term product. So if you're looking to keep it, so it minimises that time while you're stuck on the bridge. You go straight into their term product. You've only got one set of legals to do. The valuer only has to come back and do a revisit rather than a full valuation. So there are ways of mitigating those extra costs as well. For sure.
Marvellous, thank you.
Okay, just going to be typing your question in a second, sorry.
I think, David Baxter asked the question, do I do bridging loans as well? Yes, I do. But you might have guessed that, David, by me referring to them. Yes, I do.
And again, if you're interested in, quite frankly, picking Simon's brain and utilising his services, then use that link below.
Yeah, of course. And finally, Goofy.
I've met Goofy. Yeah, absolutely.
Yeah, good. Yeah, he's very expert in terms of DIY. I've seen some.
His name is Biziu, Mr. Mishevich.
Yeah, that's really uncalled for.
Who knocked down a wall in one of our rentals, which didn't need knocking down?
Yeah,
I left him for 5 minutes, Simon. 5 minutes.
Oh no!
I'm also a very good removal person.
He's dreadful at removing. He put his foot through one of our staff. He helped them move house. And Mr. Mishevich here put his foot through the ceiling as he was attempting to take things out of her loft on her day of moving and the new owners moving in.
Oh, lies.
All I will say is Mr. Mishevich is here for tax, not for removals.
I think we can move on. We can move on.
We can.
So let's go to Goofy anyway. And getting expats get mortgages. So we talked about obviously American on our America show in Hong Kong, but there'll be other people that are coming wanting to invest in the UK, whether it's in Europe, Americas, Australia, Asia. What's the process and how difficult is it for expats to get mortgages in the UK?
So they can definitely do it. It becomes a lot easier if you've still got a UK bank account, possibly a UK credit card, a UK credit presence within the UK, and an address, a postal address. If you've kept those items, that's the kind of makes it easier. If you've got an income still in the UK, that makes it even easier again. So it might be that you already own a rental property and you file a tax return in the UK. Therefore, you are self-employed in the UK. So you almost can, we still go in with an expat angle, but you are technically hybrid, as it were. But yeah, absolutely, you can get an expat mortgage, and they're not that much different to a regular mortgage, to be fair.
And just to echo the point, I've put a link. I'll just mute you for a second. But again, if anyone wants to get a buy-to-let mortgage or a bridge loan finance, then make sure that you fill in the form that we've put in the chat box. It is a property-specific one, so you must be looking. It's not a chat with Simon. It's more to do with, yes, I need a mortgage. Can Simon help me specifically with this property? Okay, so if you've got a specific property, please do reach out, fill in the form, and then send that over to Simon as well. But I don't see any more questions coming through. But why don't you give the people on the show just some rates that are being bandied around in terms of mortgages currently?
Oh, okay. Let's kick off then with, we've kind of covered the bridging one, haven't we? So 0.69 for 75% loan to value.
Hold on. Let me just type that in. So rates of interest for BTLs. And I tell you reason for that is because I can then, there's a question, everyone watching can see this as well. So rates of interest, what are the best rates of interest that you can get on buy-to-let mortgages currently?
Okay. So let's assuming it's a single let, it's in your own name. Those are going to be the most competitive. Typically, they're priced at either 2 or 5 years. There are some 3 years in between. With where we're at with interest rates, 5-year money is far more popular, as you well imagined, than 2-year money. So you'd be looking at around about 2% for a 5-year fix. It can dip under 2% as well. If you've got what's known as a simple HMO, it's a student let. All of the tenants are on one tenancy agreement. You can get a simple HMO mortgage from 1.79 for a 2-year product. 5-year product, I think, is at 2.05 off the top of my head. Moving on to more complex stuff and limited company, 2-year rates from 2.49, and that covers HMOs. 5-year ones from 2.99, I think was the best I saw earlier on today. Service accommodation, that's a little bit higher. That's going to kick in from 3.24 to 3.54 for the equivalent product. And then there's a host of EPC products out there. So if you've got something that performs well on an EPC level, potentially there's a 5-year product out there that will come in at 2.89.
Wow.
Variable versus fixed. If you go for a fixed mortgage, do you pay a greater amount of interest?
No, there isn't a whole heap of difference between standard variables or trackers out there at the moment and fixed rates. And given the fact that, again, this is a generalized televised event or published event, we're not giving advice. General consensus would seem to suggest that interest rates are going up over the next short term to medium term. I believe some of the traders in London are pricing in 1.25% to 1.5%. potentially by the end of the year into 2023. Now, do I see it going as high as that? I'm not entirely sure. So yeah, if you take out a tracker or a discounted variable, it's not going to take long before the fixed rate actually works out to be potentially cheaper way to go. And yeah, I'm doing far more 5-year fixed rates than I am 2-year fixed rates at the moment, for sure.
I mean, that's an interesting perspective because we talked about the other show about the appetite for fixed and variable. And I have always been of the opinion when mortgage interest rates are low, fix it because that gives you comfort. Years ago, the fixed rates, I remember, were 1% more than variable rates, weren't they?
Yeah, the difference is not 0.5% in places, maybe a bit less in others. It's really not that. Given that it looks to be going up, yeah, the differences are very small.
I've got a question that is not relevant to yourself, Simon, but it's a question that's come in, so I may as well answer that. It says, "Hi, Simon. Is it better to restructure the LLP as you generally teach on it? How do you? Sorry, hi, Simon. Do you LTD is a better structure LLP? Personally, I horses for courses. Okay, so general advice, I would say that there are tax advantages using a limited company. But there are so many advantages for LLPs as well. If you're using JV partners, for instance, you may have an LLP structure in place, but then have a limited company at the end. So it really does depend on your circumstances. So I can't really say for one thing or another that it is the right thing to do. I'm going to go into this question, Simon, because this comes up on our property expert panel. I'm just going to mute you, Simon. Sorry, just for that. But it says V&V again. It's coming in saying if a council brings additional licensing HMO with 3+ households, will they notify the lender so that they can classify your property as a HMO? That will change the underwriting view. That's an interesting question. What's your views on that one?
Yeah, pretty much most local authorities, when you do an HMO license application, part of the application, they will ask who your lender is and various different, so they can work out who it is, and they write to the lender. So if you're not on an HMO specific mortgage, that lender will be wanting you to change, quite rightly, because an HMO mortgage is priced differently to a normal single let mortgage. And some lenders don't, it's not within their range of appetite.
Interesting one. Yeah, it's an interesting one. But listen, thank you ever so much, Simon, for coming on the show. It's nice to have you on the Q&A.
I feel surrounded by Simons tonight. A thorn
property,
between two roses,
the
Simon.
property
That's
expert
what I am.
panel have invaded
You have.
the show. But thank you ever so much, Simon, for
Very much for having me.
Again, I'm just going to put you on mute, but thank you for coming onto the show, my friend.
May the wind settle in your area, metaphorically speaking.
My overactive mind. Sorry. Yeah. The wind is settling. Absolutely, yes.
Excellent. Not a baked bean in sight.
Well, the scent of change is upon us. So what I will say is that... Yeah, exactly. We will say thank you ever so much for those people. Don't forget to smash that like button, press the subscribe channel. I have also put links in all the way through this session to say if you want to buy to let mortgage, the form is there. Please start filling it in for specific property deals. It's not about a kind of a chat to finding out more about Simon. Please fill in the form if you've got a specific deal that you want to be sorted out on. Save the link for future reference, okay? This video will always be there. I'm going to kind of break this video out all the way through YouTube anyway, so you will see this form reappearing across multiple videos to hook you up with Simon. So, Simon, I'll unmute you, but thank you ever so much for tonight and have a great evening.
It's been lovely.
Thanks, guys. Enjoy Marbs in the sunshine tomorrow.
We'll try to.
So it's good night from me.
It's good night from him.